Thanks for joining. Our plan is to be able to let people that miss it at least learn a few more things. We're going to kick right into Q&A, wide open, go to town. We'll wrap on the hour. Anyone wants to hang around like a real live lunch event, feel free to. But we'll definitely plan on wrap the prepared part early first. So you guys get the benefit of the networking here. So to get us started off, so my name is Jason Escamilla. I'm a MBA 02 from Sloan School at MIT. Before that, I worked at an asset management firm for 5 years. Tax was a big part of what we did. Around 97, 98, Clinton had to cut a deal with the Republicans to drop the capital gains from 28 down to 20. So I built all of our software to deal with the tax management on that. So rebuilt portfolio software a couple times while I was there. It's really exciting to see how much tax-aware management has evolved. Got to spend a day with AQR a couple weeks ago, learn more about what they've got. So I encourage you guys, again, ask questions. Let's try to learn from each other. Tell us what you want to know, like what was missed. Maybe it gets answered here. Maybe we get it prioritized. So this is 201. So you guys are now experts at the 101, siloed versions of different strategies. It's even more interesting when you bring them together. So philanthropy, all that stuff, we'll do that another time, but not tax advice, just networking. That's all we're doing here, education. The goal here is in alignment with the mission of the club to connect local alum, do more events like this. So hopefully this inspires more volunteers, people that want to jump in. So exciting new announcement, the publicly open 351 ETF exchange that didn't exist last month. Definitely something you need to know about as a concentrated stock person. I posted on LinkedIn. I asked, hey, anyone got experience with this? Boom, Shang DM'd me. We were like best friends instantly. So look forward to you guys meeting him. Again, a little background on me. Tax has always been something I've been interested in. I was a paid tax preparer when I was a freshman in high school. Tax alpha has always been easier than the other alpha performance, but it's never been like a dining room table subject that people were so excited about talking like it is today. So this is for you. This is for finance professionals, accredited investors. About a quarter of investors now are accredited. They haven't changed the threshold since I got into the business. So inflation is on your side, as we said before, but also many of you guys manage portfolios for your parents, friends. Maybe you'll be able to, point them in the right direction, keep them from shooting oneself in the foot. Quick review here from before. I'm gonna answer some emails here. People having trouble with the Zoom link. I'm gonna turn it over to Shang. Shang, introduce yourself and carry us forward into the 351 exchange, and we'll just keep charging ahead freestyle here.
Okay, great. Yeah. Well, first of all, Jason, Ed, thank you guys so much for having me. And Jason, I think you mentioned earlier, we connected on this passion for tax efficient investing, and maybe I'll kind of share a little bit more of my background. And I think like most things, personal and professional interest often get interwoven. Professionally, I spent the last, call it 15 plus years building both investment solutions as well as fintech solutions for the asset and wealth management industry. My formative years in finance on Wall Street was trained at firms like PIMCO and grew up at JP Morgan, Goldman Sachs, where I held, various kind of investment professional front office roles. I think uniquely, for me, this is a subject near and dear to my heart. And I was telling, the team about this earlier, but, I'm married. The way I got pulled into this whole wealth management concentrated stock thing was, through my wife. We met when we were these two poor kids, out of grad school, and we didn't have, two nickels to rub together. But, interestingly, my wife, who's a biotech executive today, at the time, this was 2014. I had gone up to do grad school at UCLA. She very fortunately landed at a company, and I'm not sure if anyone here is in the biotech industry, but it was called Kite Pharma in Santa Monica, and Kite ended up going public. Then it got acquired by Gilead for something like $16 billion in cash or some crazy number. She then followed the founders to their next company. It was a company called Allogene Therapeutics, which also IPO'd, and at the time was the second largest biotech IPO in history. Today, she's an executive at a San Francisco Bay Area biotech called Arsenal, which I think they just publicly announced a couple months ago. They closed their Series C. And so For me, like, I was joking with Jason and Ed, I was like, I think I've made every mistake in the book, and I've felt the roller coaster ride. I know what it feels like to have the IPO, the euphoria, the greed, the excitement. I also know what it feels like when the stock tanks 30% in a day and you're looking at your brokerage account like, oh my goodness. And then for me professionally, I think I have this unique perspective where obviously growing up sort of on the institutional side of Wall Street and, seeing how the most sophisticated investors did this. I also spent 4 years of my life as an advisor, most recently at Goldman Sachs, working with ultra high net worth individuals, many of whom were technology company founders and executives. And, the business that my team and I did was, we would partner with Goldman Sachs investment banking team, for example, and whenever Goldman did an IPO, they would bring us in to meet with their C-suite, and then post IPO, we'd bring in all the single stocks. So we use some pretty sophisticated stuff that I'm happy to kind of dive into later. And then uniquely where Jason and I connected recently was, I think most of you have maybe seen some buzz around this, what's called the Section 351 transfer. I describe it as 1031 for publicly traded securities. So if anyone's ever done real estate, if you have an investment property, you can sell it, defer the cap gains as long as you buy something else. This is kind of similar, but what you can do is you can do something similar with publicly traded securities. So stocks, ETFs, ADRs, even some bonds. And uniquely, a couple years ago, in my role right now, I'm the chief revenue officer of an ETF firm. I did 3 of these transactions for a wealthy LA individual who's, we worked with his family office to diversify a very concentrated stock position and turn it into a diversified portfolio. So I've seen hands-on how this stuff looks and feels. Happy to kind of dig into that a little bit more, and certainly want to be most helpful to this group. So maybe I can pause there, and I don't know if people want to kind of choose your own adventure and just maybe start asking questions, or I'm certainly happy to kind of walk through some of the prepared slides as well. So I'll take a just pause, and Jason, guide me to wherever is best. Yeah.
Yeah, I mean, if you want to kick off the 351 exchange, what that is, that can help guide some of the questions. I'll give you a minute. I'll just kind of, rip through a couple more slides here. So our goal here is we got all these things we talked about. There's a 351 ETF exchange you guys can do. You remember California is a great place, but some high taxes. And so specifically, just kind of a review, I put another slide together to help you guys. So this is how it works. You take all your income, you throw it together. You got adjustments, alimony, your 401k, you got your deductions, and you're left with this over here. And you get to move the blue stuff to the top. So that's your cap gains and qualified dividends. And that's how you figure out what those are going to be taxed at. So not everybody's in the top bracket, but if you have if a huge percentage of your salary, like a typical tech worker, got paid in RSUs and you are liquidating something you've held for a long time, it's near sure thing. If you try to do that all in one year, you're hitting the top brackets. So the strategy, again, your lifetime taxes, how tax-aware investing involves improving that, but it also includes things like incorporating the whole step up upon death. Okay, lifetime taxes. If there's a spouse involved and you're in a community property state, there's other advantages you might have. You might actually want to stay in California, but just encourage you to check out some notes from before. This is the game here. California has the highest taxes in the world, short of Norway, just a hint more, or France. But if it's GLD, if the largest ETF in the world on gold, protected you from inflation until you take the tax away, and then boom. All right, Shang, you want to do a quick explanation of the Section 351 and how that works, what that's for, as it relates to the concentrated stock versus cap gains crowd?
Yeah, no, absolutely. And maybe if we could take to the next slide, Jason, 21. And I'm going to take a big step back, right? And I think we'll get into 351 very shortly, but, having seen this with my own family, I think obviously no one's ever trying to pay more taxes than they want to, or they should. So that's important. Taxes are super important. Like, we have to do things tax efficiently. We have to abide by the rules and laws, which Section 351 obviously does. But I do think there's 2 important things I wanted to touch on that are, I think, at least in my mind, a higher priority. One is your personal risk appetite. And so how much risk you're comfortable wearing. And I can tell you with our family, after our second IPO, my wife and I looked at each other and we would always do this because we thought the stock was going to go to the moon. And, we were like, oh, it's 20, 30, 40, 50, and we always kind of had this number in our head. And, we very much leaned into the greed side of the spectrum. If you think of, fear and greed, and that was our risk appetite, right? So we knew what we were doing, but not everyone's going to have that. And so importantly, you have to find out where you're comfortable and how much of this single stock risk you want to wear. I don't think I could ever predict where their stock is going, but if you look at the empirical research, if you look at the CRSP stock database, I think there's like 25,000 stocks that are in there. The mode, so the most frequent outcome is of returns of that database of stocks, is minus 100%. So the most frequent outcome is these things go to zero, right? We can get into this very highbrow discussion on idiosyncratic risk and how to diversify, but we don't have to, but just think about that. And if you want to cut that left tail off, diversification could be a good thing to do. The other thing I'll mention is, goals and objectives, right? And we all have goals. We all want to do things like, I have 2 kids. I want to save for college. I want to, upgrade my house, or I want to buy an investment property. Whatever these goals are, I think we shouldn't forget about that, and we should keep those in sight. And if it means paying taxes on a gain, but it meets your goals, like at least for me personally, I think it's worthwhile. So, which I share that because all this stuff is very qualitative and everyone's different, which is why I think speaking to someone like Jason, an advisor, for me, I know I would have benefited tremendously when I was going through this. Instead, I tried to kind of, thick-headedly kind of muddle my way through. So, anyways, back to the 351 stuff. So I think very simply, from a pure economic bottom line perspective, why might you want to consider something like this? Well, and I do apologize. Looks like the chart got a little bit cut off, but really the punchline is, if you just use a very simplistic example, in this case, $10 million, but you need $10. You have a $10 position, $10 million position, and you want to diversify it. The most straightforward way is to go sell that, turn it into cash, pay capital gains. In a state such as California, it could be as much as 37.1%. In a state like Texas, maybe 23 or so percent. And then once you have turned that position into cash, you buy yourself a diversified portfolio, maybe the SPY ETF or something like that, right? So if you did that, you start from a lower starting point, in this example, 6.66 million or so. And then assuming a compounded growth rate of 8% over 7 years, you end up somewhere around, call it 11 million, right? Now, let's say in this scenario, you were able to do that, but you were able to start at the $10 million starting point. How does that look 7 years down the line? It's actually something like 17.1 million. And as we can all tell, we all went to MIT, we're pretty good with numbers. This is a much more desirable outcome, right? So point is, ideally, we can start as close to that 10 million without having to take the capital gains haircut. And then we can continue compounding, right? And so that's really the I don't even want to call it secret sauce, but that's the general idea of what we're trying to do here. And Jason, maybe you could go to the next slide. And speaking very frankly, like for everyone, like I'm in the asset management industry right now, and so what the asset management industry does as a whole, we manufacture products, and now you're going to talk to a lot of people from really smart firms, whether it's my firm, AQR, any of these companies. They're brilliant. They hire the best and the brightest. A lot of these folks have a lot of letters after their name. They probably went to schools like MIT. They're super smart, but you can't ever forget their goal is to sell you a product. And the reality of that is when people are trying to sell you products, when you're a hammer, everything looks like a nail. So chances are you might encounter folks in, some of these products you might recognize. So hedging strategies, exchange funds, even the Section 351. I wouldn't be surprised if someone approached you from one of these companies and made it sound like this was the panacea, this was the end all be all best thing ever. And so something to just keep in mind. Now, a lot of these ideas are terrific. And I think Jason alluded to this at the start, but where the magic really happens is if you work with a really great advisor or someone who knows what they're doing, and they can combine these in very thoughtful, innovative ways and different combinations to ultimately help you achieve your goals, what you want to do with your life, with your assets, for your family, and within your risk appetite. So that's sort of the secret sauce, I think, behind all of this. I won't talk through all of these because I know we can just drag on and on, but we're happy to kind of circulate this, Jason, after if helpful. But maybe if you could take to the next slide, we'll talk specifically about Section 351, how it works. So as I said earlier, the 351 thing, it looks and feels a lot like 1031 for real estate, right? So what we do effectively is we are leveraging two different legal, IRS and SEC rules or regulations. So Section 351, it rides on the same regulatory guardrails as the 1031 exchange, but effectively it says if you seed assets into a corporation, there's no immediate taxable event, right? And I'm pretty much, very, very shorthandedly describing this thing. There's a lot more language behind it. But what actually is the case is that an ETF is a type of corporation, a registered investment corporation, RIC. So as I was kind of crossing these paths like 2 or 3 years ago, we learned very quickly after speaking with our legal counsel, hey, you could actually seed assets into an ETF account, which is technically a corporation, and you didn't have to incur any taxes right away. The second part of the puzzle, which is kind of a little bit where the magic happens, is within ETFs, the SEC years ago passed this Rule 6C-11, and I won't get into what it was, but it basically says you can do custom redemption baskets. And what is that? And so there's something I highly recommend if people are interested in kind of digging into this more. You can Google ETF heartbeat rules or heartbeat trade. And the heartbeat trade is used to the tune of, I don't even know the notional amount, but probably trillions, if not hundreds of billions of dollars every year. And what the heartbeat rule does is basically it's the reason why most ETFs, not all of them, but most of them actually don't have capital gains. And so ETFs, as a whole, are one of the most tax efficient investment vehicles out there in the market today. And a big reason is because you can do this where you do a heartbeat trade. And I'll give you a very simplistic example. If you think of an ETF as a cardboard box, and let's say our cardboard box has $100 of Google stock in there. I'm just picking, a random stock. Let's say we bought the stock at IPO and, just using very simple numbers, we bought it for $1, right? And so you have a $99 capital gain within your cardboard box, which is your ETF account. Now, if I were to sell that stock in the ETF, I'm the ETF trader, I'd have to incur a tax or capital gain. My ETF, my box or my corporation would have a taxable event. Now, ETF businesses are doing these types of heartbeat trades daily. And what we can do is we call up our friends who are market makers and people that create, they're out there creating a market for these boxes. And we can say, I need a favor from you, right? I need you to do an in-kind creation. And what that creation is going to look like is that in-kind creation unit is going to look like what's exactly in my box currently. So my friend is going to say, gotcha, I got you. So they're going to make another cardboard box, or not necessarily a box, but they're basically going to take $100 of Google stock, give it to me to create more shares of the ETF. So now my box has $200 worth of this Google stock. But now the thing to keep in mind is 100 of that had that very low $1 cost basis. The other part of it was cost basis of whatever was they just purchased it at the fair market value today. Now I can wait 2 days for everything to settle in place, and now my box has $200 at Google. I then call up my friend again and say, okay, we're ready to go. Time for you to do a redemption. And so they hit the button to say redeem. And for them, they say, well, I want to request a custom redemption, and that is going to be in the form of $100 of Google stock. And so me as the ETF issuer, what I can say is, I gotcha. I am now going to push that $100 of $1 cost basis out of my box. So my new box is $100 of Google, but the cost basis has been stepped up significantly. And so this is a really simplistic example of what happens. But you can imagine if you did this in a very thoughtful, systematic way, you can really wash out a lot of the capital gains. And this kind of ties to this Rule 6C-11. And so when you combine those two pieces where you create an ETF, you seed it with appreciated assets, you can systematically and very tax efficiently wash out those cap gains, transform it into some other type of portfolio. Now that portfolio can be predetermined where, let's say the stuff you were seeing the box with or the ETF with was 4 or 5 different stocks that had appreciated significantly and you wanted to de-risk, turn it into a SPY or a 60-40 portfolio, whatever, 70-30, you could easily do that, right? And so now you can just see kind of how this happens where one, you can eliminate the idiosyncratic risk that's carried with these stocks, turn it into something a little bit more diversified or that fits your investment objectives. But importantly, you got to defer those capital gains indefinitely and continue to compound. So I know that was a lot, so I'm just going to take a breather, pause. I don't know if we want to take any questions, Jason, but let me know how best to be of help here. Yeah.
Cool, yeah. And let's give some examples. So like, let's say you got, and this does not apply, but let's, for example, like there's that mutual fund that owns mostly Tesla. I forgot the one, but you're paying a massive fee. You made a lot of money and you're stuck. You're kind of stuck paying, paying for Ron Barron's, cars and whatnot. But what if you could swap that in? Now you can't do his overpriced mutual, well, not overpriced, but you got your money's worth, but you can't, there are other cases where you might be in other assets. Maybe it's a high dividend paying stock that you don't want, or a low growth stock that you don't want, but taxes have kept you from rebalancing. This is a rebalancing opportunity for your portfolio. The other question is, and I don't know if I get the AQR guys to jump in. If swapping a handful of your concentrated stock for an ETF, if that gives you better leverage for their Flex 250 portfolio, that's another example. Another way to think about this is just the first of many to come. You're getting, whatever you're throwing in there, you're doing the exchange because you can't sell it. It's like otherwise you would just sell it and do something simple and buy. But you may have highly appreciated securities and you don't want that risk. And you don't, and this is a great way to be able to rebalance your portfolio. And so that's essentially the opportunity for you. Let's see what these questions are. Now, the heartbeat, that's the piece, that's the beauty of an ETF being tax efficient internally. It's not going to trigger gains when they do that. So they can clean up all the stuff you give them. You're limited to the Russell 1000. And I've been encouraged to stick with Russell 1000 as your universe, basically. There's ADRs in there, about 20. Oh, the point I was going to make was there's going to be more of these coming. So, you pay Cambria 59 basis points. Well, you might have been paying someone else a lot more. That at least the 59 basis points comes like pre-tax out of your cap gains, so you got that going for you. That's another use case for it, I guess. But 6 months down the road, 12 months down the road, either this is going to be made illegal, or we're going to see them all over the place. And you're eventually going to be able to roll your highly appreciated securities into for a handful of basis points per year, and then be able to wait until someone passes, or use that to donate, pop it over to your CRUT or whatever. So let's see, we got some questions in here about the heartbeat trade. So the heartbeat, that's an internal thing, by the way, guys. That has nothing to do with your portfolio. Like, you'll just never know anything about it. It doesn't change your cost basis at all. All it does is, that's really a difference between mutual funds and ETFs. Mutual funds, they can't do the heartbeat. If they do a rebalance, they trigger tax internally and kick it out to you. ETFs, when they're managed properly, they don't have to worry about that. Anything to add, Shang, or should we open it up wider?
Yeah, that's all exactly. And I see Ben and John's question about the taxes. Yeah, that's the crazy thing, right? And I know with my friends in the ETF world, we've often said like, is there some kind of risk politically where people are going to take a look at this stuff and say, well, geez, like, we need to figure out a way to tax this? But I think, at least my personal impression is that, I think ETFs are perceived as more Main Street than Wall Street, right? It's really a mom and pop product. And so I don't see a ton of risk on the immediate horizon where something like the heartbeat trade might be regulated. And then I see a question on, how new is Section 351? Why is it not well known? It's exactly what Jason said. It has been around. If you guys ever follow the asset management industry, you may have seen mutual fund assets have been slowly declining and ETF assets have been increasing, but there's a lot of people converting mutual funds to ETFs, and that's a similar type of transaction. I do think, maybe two quick comments here. One, the reason why we're starting to see more of it, and we didn't see as much in the past, was that historically ETFs, the industry was dominated by the top, call it 3 or 4 or 5 players, right? I'm sure we can all name them: Vanguard, BlackRock, State Street, etc. And if you look at that, if you sit in their seat, right, like, they have this amazing cash flow business, cash cow, that is growing quickly. It's just very attractive, right, to be one of those 3 players. why lean into this? This is just like, kind of murky. There's a little bit of like, legal stuff that you have to figure out before you can do it. And now on the other side of the spectrum, smaller firms, like at least for me, if I was either a family office or an individual, I wouldn't necessarily want to work with a smaller ETF issuer to kind of do this. So really there's a sweet spot. And that's why firms like, like Meb Faber's from Cambria, they're able to step in because one, they're terrific. They've done a lot of really great work, a lot of experience, right? They've launched a number of ETFs successfully. They've built the sort of rails that this type of operational experience would travel on. And that's, I think, really it, right? So you want to figure out like where really the sweet spot is, where firms that are eager to grow, to bring innovative solutions to market, but are also have been around long enough to really execute on something like that. I think that's a really, really big piece of it. So I'll pause there. Yeah, and I don't know, Jason, if you have thoughts to add or.
But Andrew was going to give us some updates from iCapital. Andrew Garten, he had some updates on Eaton Vance exchange fund that's coming. And there's some interesting developments in the qualified opportunity zone space where, as for those of you might recall, you'll see in the notes, qualified opportunity zone, that's where there is reinvestment in the areas that have been designated. And it's real estate based. So a lot of those deals have come down in price. And so as new money goes in, there's actually an opportunity to get an extra write-off, another bite of the tax benefit on that. So something to look into if you're looking at qualified opportunity zone. Hey, Andrew, thank you. All right, man. Yeah. You got time to pop in with any other updates?
Yeah, sure. Happy to. I guess real quickly on the exchange front side, we will have both the Belnova and Clear Lane exchange funds available in November on our platform prior to their year-end closing, which they will hold in December. And then additionally, on the Opportunity Zone Fund side of things, there's an interesting kind of twist, as Jason mentioned, with the sunsetting of the Opportunity Zone Fund legislation, which was part of the Tax Cuts and Jobs Act, TCJA, back in the end of 2017. And as that legislation sunsets, effectively, it will trigger a revaluation of the Opportunity Zone Fund properties that are being developed inside of that fund. And what that does for sponsors who have a partnership structure is they can revalue the portfolio effectively at the bottom of the J curve in the middle of that development process as they're building new apartment buildings, let's say, as an example. And what that does, then you have to take into consideration the marketability and the value of that asset at that time in which you're appraising it. And so what that does is it allows the Opportunity Zone Fund to actually generate a paper loss that can then be passed through to you as the investor to offset the very capital gain that you used to invest in the Opportunity Zone Fund originally. And so it becomes a very interesting tax vehicle for folks that may want to take a look at Opportunity Zone funds. And, I would say first and foremost, yes, that is real estate. But it's our opinion that real estate is actually, because it has come down in value, in particular in sectors like multifamily housing, given the fact that we still have a housing shortfall in America of about 3 million housing units. We still have positive rental income growth in apartment buildings, but the prices have come down about 26% peak to trough. And therefore, our opinion is that it is an attractive entry point today and not a bad time to start looking at real estate if that's something that would complement and help diversify your overall investment portfolio. So I'd say first and foremost, you have to be interested in having a real estate investment in your portfolio. But if that's the case, more than happy to have a follow-up conversation with anybody. Work very closely with Jason and certainly happy to get on the line with anybody one-on-one if that would be helpful.
Yeah, and that includes your advisor too. So thanks, Andrew. I'm going to turn off the recording to make it a little bit more free form for everybody.